In the heart of our interconnected world, from the glass towers of New York to the bustling markets of Tokyo, a quiet unease is brewing. The familiar rhythm of global finance, once a symbol of endless growth, now beats with a nervous tremor. Digital tickers flash red, charting a descent that whispers of instability. Beneath the surface of our globalized prosperity, fault lines are beginning to appear, threatening to trigger the next economic earthquake. We stand at a critical juncture, where long simmering vulnerabilities are coming to a head, forcing us to question the very foundations of our modern economy. The most glaring of these fractures is the mountain of debt, casting a long shadow over nations, both rich and poor. For years, governments have borrowed on an unprecedented scale, fueling growth and funding public services. But now the bill is coming due. In developed and developing countries alike, sovereign debt has swelled to historic proportions, with debt-to-GDP ratios climbing to precarious heights. This isn't just an abstract number on a spreadsheet, it translates into tangible strain. We see it in the crumbling infrastructure, the underfunded hospitals, and the strained social safety nets of once thriving nations, where the cost of servicing debt leaves little room for investing in the future. This colossal burden makes economies fragile, highly susceptible to shocks from rising interest rates or a sudden loss of investor confidence. Further compounding this fragility are the nations whose fortunes are tied to the whims of the global commodity market. Entire economies, from the oil fields of the Middle East to the copper mines of South America, have been built on the export of a single resource. When prices were high, prosperity flowed. But this dependency creates a perilous boom and bust cycle. As global demand shifts or new technologies emerge, the once mighty engines of these economies can grind to a halt. We witness the silent spectacle of idle oil rigs and shuttered mines, symbols of a prosperity that was as volatile as the market it depended on. For the people in these nations, the consequences are immediate and severe. Jobs vanish, currencies devalue, and social unrest begins to simmer as the promise of a better future evaporates with the falling price of their core export. Yet vulnerability is not confined to indebted states or commodity exporters. It also lurks within the gleaming hubs of the developed world. In the epicenters of technological innovation and finance, bubbles have been inflating for years, driven by cheap money and speculative fever. The tech sector, once the unstoppable engine of modern growth, now shows signs of overvaluation, with valuations detached from fundamental profitability. Similarly, real estate markets in major global cities have soared to dizzying heights, making housing unaffordable for many and creating a market built on leverage. The proliferation of for sale signs on sleek office towers and quiet suburban homes serves as a quiet warning. A correction in these overheated sectors could trigger a cascade of failures, wiping out wealth and dragging the wider economy down with it. As we pan across the globe, a complex map of risk emerges, connecting these distinct but interwoven vulnerabilities. From the indebted nations of Europe to the resource-dependent economies of Africa and Latin America, and the speculative bubbles in North America and East Asia, the potential for a synchronized global downturn is palpable. We are left contemplating a world balanced on a knife's edge, a system where a crisis in one corner can rapidly spread across the planet. Yet in this moment of profound uncertainty, there is also a story of human resilience. Looking out over the vast, glittering expanse of our modern world, we are reminded that our collective future will be defined not just by the challenges we face, but by our capacity to recognize them, adapt, and build a more stable and equitable foundation for the generations to come.